In this video, I'm going to go over covered strangles, and I'm also going to run through an example of a trade that I actually just put on, so hopefully that'll give you a really good understanding of how the strategy works and when the appropriate time to use it is. So stick around after the intro, and I'll show you how to add covered strangles to your trading strategy. So let's start with the basics. What exactly is a covered strangle? Well, in its most simplest definition, basically all you're doing is you're buying a stock, and then at the same time, you're selling out of the money calls and out of the money puts against that stock position. So when would you want to do this? Well, you'd only want to use this strategy if you're moderately bullish on a stock. So typically this would be on a stock that, let's say it's been in an uptrend, or it's currently in an uptrend, but right at the moment, maybe it's trading sideways, it's trading within a trading range, it's maybe squeezing, and it hasn't broken out yet to those new highs. That would be the ideal time to use this type of strategy. The reason you only want to use this on moderately bullish trades is, well, two reasons. Number one, this strategy limits your upside profit. So if you had a stock that's in a really strong uptrend, making new highs every day, this really isn't the right strategy. You'll still make money, but there's better strategies out there for those types of markets or those types of stocks. The second reason is the downside risk increases pretty fast once the stock moves below your short put strike when you're using this strategy. The reason for that is you're now losing double the money. You're basically losing money on the stock that you purchased, and you're also losing money on your short puts. So you really want to make sure that you're properly setting your stops on this trade and that you really have a good strategy for how you're going to exit the trade before you even get into it. So let's look at a few ways that this trade can play out. First, let's look at the good side. Let's look at, what's our maximum profit? How much money can we make with this strategy? Well, your maximum profit will occur if you get called away. So in other words, at expiry, if the stock price closes above your short call strike, your stock position will get called away, and that'll be your maximum profit. And I'll show you here in a little bit on just exactly how to calculate what that is. Now let's look at the flip side. So what is the maximum risk on this strategy? Well, the actual dollar amount, the dollar value of risk, is going to depend largely on where you place your stop. Now you have to remember that risk in this strategy can be quite substantial, and it's also leveraged once the price gets below your short put strike. In other words, once the stock price drops below whatever level you sold your put at, you're going to lose almost $2 for every $1 loss in the stock price. Because of this, you really need to have a good plan before you get into this trade of where you're going to exit, and then you need to have really good trading discipline, to make sure you cut any losses small before they get out of hand. As far as break even, that's a pretty simple calculation. Your break even point is basically just the stock price where you bought the stock minus the total premium received, and that's basically your new cost basis and your break even point. This probably all sounds very confusing or complicated, but it's really not. It's actually a fairly straightforward strategy. You just need to have a clear understanding of the potential risk reward, have a plan before you even enter the trade, and have the discipline to stick with it. All right, let's go over an example, and this will hopefully really clear things up and show you how to correctly use this strategy. So this is a trade that I actually just entered myself. I put this trade on in the morning on Friday, March 17th. But before we go over the details of the trade, let's just do some technical analysis first. Anytime you're getting into any kind of trade, doesn't matter if it's, if you're just buying stocks, if you're trading stocks or options, you want to do the technical analysis first and, make sure you have a good understanding of what the probability is for the stock either moving up or down before you get into the trade. So we can see on semiconductor, and actually if you look at just the semiconductor industry in general, it's actually performed really well over the last several months, even better than the S&P 500. So what you want to do when you're using this strategy is you want to find a sector first that that is performing well, like the semiconductors are, and then within that sector, you want to look for stocks that are really outperforming the entire sector. So basically, you're looking at the best of the best. And you can see on semiconductor, even throughout this entire bear market, it's pretty much just held up within this range. And now as of recently this year, it's broken out to new highs. I mean, if we look at, from the all-time high, or let's say the 52-week high, I mean, it's only down about 8% at its current price. This tells you it's a very strong stock, and it's something you want to look for to continue in a bullish pattern. So that met our first criteria. We have a stock now that we're moderately bullish on. So now let's do some deeper analysis and find some support and resistance levels. So when we look at this chart, we can see that it was in this nice uptrend. It actually had a really nice rally here, and now it's starting to squeeze. So if we draw some trend lines, you can see that the stock is really starting to tighten up. The price action is starting to tighten up. The Bollinger Bands are getting tighter. It's forming this triangle pattern. So those would be our first level support and resistance lines. Now we can also look at, this was a really strong resistance level over here. And if we draw a line out through this area, we can see also that this previous resistance level has now turned into support. So where it was resistance, 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 finally broke through. And then you can see it's held support several times already. Had one breakdown, but even on this day, it broke through just to test that 50-day moving average, but immediately within the same day came up and still closed above that support level. So I would still count that as support. So even though these lines are really close together, technically this is our second support level. This would be our primary support level. Looking at resistance, again, that would be our primary resistance, and we can draw a line, pretty much right at this last high over here. This would be our second resistance level. If we want to look further out than that, this low here where it tested the 50-day moving average, that would be our third support, and the 52-week high, that would be our third resistance level. So those are all our support and resistance levels that we want to be aware of before we get into any kind of trade. Now, for the purpose of this one, we can remove these two. It's just cluttering up the drawing, and really we want to focus on these levels. So when I got into this trade, I purchased the stock at $77.96. So right around this level here. Now, when I did that at the exact same time, ideally you want to do this all as one trade. I mean, if you do it as separate trades, that's fine. But the easiest way to enter this is all as one trade. So at the exact same time, I sold the $83 calls, and for those I received 65 cents in premium. And I also sold the $73 puts, and for those I received 77 cents in premium. So when you put all that together, my net cost basis, my net cost in this trade was $76.54 per share. Now let me just show you one other thing on why I selected the levels that I did for the calls and the puts. I mean, obviously you can see, $83 is the resistance level here. $73, is right around there. So basically right above this previous low. But there's one other reason. If we look at the options trades, so, and I talked about this in one of my previous videos. I did a strategy video on the wheel option. So you'll definitely want to take a look at that one too. That's also a really good strategy for slightly bullish trades. So, but what I want to point out here is, so this is the expiration, March 24th that I chose. And when you look over to the right, the option market is incredibly good at predicting the maximum move in a stock price over a given period of time. So what this is telling you is that between now and March 24th, the option market is predicting a move of just over $5 in this stock. So again, if we look at it, so it was right around $78 when I purchased it. So if you subtract and add $5 on each side of that from 78, you basically come up with $73 and $83. So those are the reasons why I selected those strike prices. And also, if you look at $73, the delta at that strike price is only 0.18. So it's telling you only have an 18% chance of the stock moving lower than $73. Similarly at the $83 level, if we look at the delta, it's 0.23. So again, you only have a 23% chance of the stock moving above that price. So you want to sell these far enough out that your likelihood of getting called away or getting assigned additional stock is fairly low. All right, so let's go back to the chart and let's crunch some numbers now and see what, with this particular trade that I put on, what is my risk reward? What's the most I can make if I'm correct about my assumption, and what is my biggest risk if this trade does turn against me? Actually, before we do the numbers, just one more thing I want to mention. So remember, my thesis on this trade is that the stock is in an uptrend, had this really nice rally, made a new high, and now it's consolidating and squeezing. So my thesis on this trade is that the stock will continue to trade sideways within this triangle, the Bollinger Bands will continue to tighten, and eventually the stock will break up out above this resistance line and start making new highs again. So if that's my thesis, you want to make sure that if the stock does something that violates that or that goes against what your thesis is, that you close out the trade. So in this case, my plan is not to hold this trade all the way down to $73 if it were to start moving against me, even though that's where I sold my short puts. What my plan for this trade is, if this stock were to turn against me and if it were to close below the 50-day moving average, or if it were to close below this rising trend line, and definitely if it were to close below this support line, which was previous resistance, so that's right around, let's say just right around $76 or just below $76, that's where I'd exit the trade. So on this trade, I put my stop, right around, let's say 75.50. And if the stock gets below there or closes at that level, I would exit the trade. So just keep that in mind when we're going through these calculations. So let's first look at what is our maximum profit. So at expiry, remember we said the maximum profit would occur if the stock price increases above the strike price of the calls that you sold short. So in this case, my maximum profit would be $83 minus $77.96, which is what I paid for the shares. But remember, you also get to keep the premium. So we'd keep the 77 cents and the 65 cents. So you add all that together, multiply by 100, and you get a maximum profit of $646. Now that's 8.4% in just 1 week. So that's not bad at all. Now let's look at the flip side. What's the maximum risk that we're gonna take? Now remember, I said I'm not gonna hold this trade if it gets below around 75.50. I'm gonna close it out. But let's look at some worst case scenarios first. Let's say if you were to hold this all the way down to $73. So let's say the stock closes at let's say 73.01. So right at the point where you're not going to get assigned additional shares for the short puts that you sold. At that point, your loss would be $73 minus the $77.96 that you paid for the shares. But again, you do get to keep the premium you collected. So we got to factor in the 77 cents and the 65 cents. So you add all that together, multiply by 100 shares, and you get a maximum loss of $354. So that's not bad at all. I mean, that's almost a 2-to-1 risk reward. 354 compared to the 646, it actually works out to a 1.82, I guess, reward versus risk scenario. So not bad at all. And like I said, I would get out of this at just below $76. So really that puts me at about a 2-to-1 risk reward, which is really what you want to target on these types of trades. All right, one other thing I want to show you. This is for all you visual people out there, just like me. I like to be able to visualize my trade. So I draw up these charts to show what the maximum risk, maximum reward really is. So you can see on this graph your maximum reward of $646. Basically, that just flatlines. It doesn't matter how much above $83 the stock price goes. That's your maximum profit, and that's all you're going to make on this trade. You can also see your break even at 76.54. Again, that was just the stock price, what you paid for the stock, plus the premium that you collected. That gives you $76.54. But what I really want you to notice on this chart is look how quickly your losses start to grow as the stock price starts to fall. And especially when it gets below $73, your losses grow very quickly. So with this kind of trade, you really want to make sure that you understand what you're getting into, you understand the risk reward. You really want to do good chart analysis before you get into it so you know where your support levels are. And you got to have good trading discipline. And this is a strategy where your losses can get out of control very quickly if you don't follow your trading plan. So you need to know what your plan is before you get into the trade. You need to have an exit strategy on where you're going to get out, and then you need to have the discipline to make sure that you stick with that strategy. All right, well, that's all I got on cover strangles. Feel free to follow along next week. Keep an eye on this trade. We'll see how it works out. Hopefully by the end of the week, I'm closer to that $640 profit and not on the, on the $300 loss side. But again, I mean, it's impossible to predict what the market's going to do. So anytime you're doing any kind of trading, as long as you know what the risk reward scenario is and you're comfortable with it, and as long as, the reward is higher than the risk, as in this case, we're almost at a 2-to-1, then, you should be fine. And in this strategy, you'll be profitable when you use covered strangles more than 50% of the time. So if you're getting close to 2-to-1 when you're correct and you're profitable 50% of the time or more, over the long term, you're going to do really well in your account balance. So hopefully this format of video works for you. I like to go over the theory first and then run through a real live example to really show you on how to what to look for and how to implement the strategy. And so if you're enjoying this content, please hit those like and subscribe buttons. It really helps us a lot. And we'll see you next time.